The Fed FOMC Meeting Minutes. Just some quick thoughts. It happened yesterday or a couple days ago?
What is today? Wednesday? Yeah, it was yesterday.
Okay, so can you go through what it was? What was kind of the takeaway?
When they released the meeting minutes notes, it's actually just a press release, so it's not like a public broadcast. The Fed has two tools available to them. They can raise rates and they can use their voice. So in November, they didn't raise rates, and the market was getting really restrictive. Interest rates were going over 8%, and we're just getting pinch on the liquidity side. They didn't raise rates. Bonds came down a little bit, and interest rates cooled down slightly. So what I thought was going to happen in these notes, because the notes are released later, so there's time for them to come in and move some notes around to change the message. Because remember, they only have the Fed funds rate and the message. So I thought the message was going to come out a little stronger, to be honest. This came out pretty dovish, in my opinion.
Dovish, not as aggressive.
Not as aggressive.
Yeah, a little more conservative.
Soft. Not as hawkish. Not as we are going to just do whatever it takes, no matter what breaks. Now, of course, this is my opinion. Other people probably disagree. But basically, they were unanimous, so there's no dissension yet on the Fed board. I think as we near the end of this inflation cycle and interest rate cycle, we're going to start to see some dissension. You're going to see the doves break to one side and the hawks break to another side. But right now, unanimously vote not to raise. So the stock market right now is betting no raises in December. So the Fed staff expected potential growth over the next 2 years to be roughly flat, with unemployment up slightly between now and 2026. They talked about not having rate reductions until then, but the stock market and everyone else is betting against them. They talked about real exports and imports and of goods, and how services were still growing at a robust pace. But it's interesting because China and Germany have started exporting their deflation over to us. In other words, inflation is the rate of price increases. Deflation is prices actually going down. And in Germany and China, they are actually seeing some deflation in their market. We are still inflating in ours, but then that comes our direction through cars, through computers, through TVs, things of that nature. That was really interesting.
They said this in the meeting?
It was in the notes, yes.
Interesting.
Another thing that was really interesting was, and this is where the hawks and the doves might break against each other, there was talk about how if they did lower rates, how would that affect quantitative tightening? So quantitative tightening is where the Fed is lowering their balance sheet by selling off the bonds that they've been buying. So that's one thing that's been keeping rates up, is that quantitative tightening. If interest rates and real rates, we talked about this on a different podcast, if inflation comes down, then the effective real interest rate to businesses and consumers is higher. So therefore they could lower and still be in a restrictive stance. Can they lower and continue quantitative tightening at the same time? Don't know. Never been done in history. Or would those work opposite each other because they're different monetary factors? Lastly, the Fed basically said, we're not done, higher for longer. And the stock market and everyone else is saying, yeah, right. Yeah, hold my beer. We don't believe you. So, okay, our prediction is that we believe, one, we've seen peak interest rates in this cycle, unless some major thing happens. Two, that interest rates will come down into the sixes sometime in 2024. Three, as interest rates come down, that will cause residential real estate and commercial real estate. It'll start to slowly buoy up commercial, but it's going to cause residential to really light back on fire. In the sixes, it'll probably unlock a lot more demand. That was one of the things that they did warn about lastly, was there is potential for a sharp decline in commercial real estate valuations and other assets, aka stocks, bonds, things like that, that may be experiencing overvaluation due to the loose monetary policy. And we've mentioned this before, but we know office and commercials really beat up. We know multifamily is going through some struggles because of these high rates and bridge debt. I read somewhere, though, only 3,500 multifamilies are generally in trouble. But these are big multifamilies. So this is multifamilies that are over 50 units. So roughly about 3.5% to 4% of the total multifamily market has the potential to be in trouble right now. Because the dollars are so big, that could be a lot lot of trouble, but it's not a 2008 bubble tsunami crash because those foreclosure numbers and trouble numbers were almost 3 times that. Yes, there's pain coming to multifamily. So let's go back to what we just talked about in our second discussion item. There's going to become this crazy inflection point where caps right now, cap rates are rising in multifamily. In other words, the yield that it gives you, your return on your investment is rising right now. And sometime in 2024 or 2025, and it's going to be different for every metro, there's going to become this point where you're going to be able to do a land development project that's multifamily or townhome, or buy a multifamily where the cap rate is still rising, but interest rates are actually trending down. And the seller that's not totally paying attention to that is going to give up more opportunity than they need to. Because as interest rates go down, cap rates will naturally start to float back down.